In this episode of the Mornings with Joel CRE Podcast, Joel sits down with Derrick Barker, co-founder and CEO of Nectar, to explore how alternative capital is reshaping commercial real estate financing. Derrick shares his journey from Wall Street to becoming a multifamily investor and entrepreneur, along with insights into scaling real estate portfolios without relying solely on traditional bank loans. Whether you're an investor, broker, developer, CRE professional, this conversation offers practical strategies for navigating today's lending landscape and unlocking new growth opportunities. Live starting soon. Ask your questions in the chat. In this episode of the Mornings with Joel CRE Podcast, Joel sits down with Derrick Barker, co-founder and CEO of Nectar, to explore how alternative capital is reshaping commercial real estate financing. Derrick shares his journey from Wall Street to becoming a multifamily investor and entrepreneur, along with insights into scaling real estate portfolios without relying solely on traditional bank loans. Whether you're an investor, broker, developer, CRE professional, this conversation offers practical strategies for navigating today's lending landscape and unlocking new growth opportunities. Live starting soon. Ask your questions in the chat. In this episode of the Mornings with Joel CRE Podcast, Joel sits down with Derrick Barker, co-founder and CEO of Nectar, to explore how alternative capital is reshaping commercial real estate financing. Derrick shares his journey from Wall Street to becoming a multifamily investor and entrepreneur, along with insights into scaling real estate portfolios without relying solely on traditional bank loans. Whether you're an investor, broker, developer, CRE professional, this conversation offers practical strategies for navigating today's lending landscape and unlocking new growth opportunities. Live starting soon. Ask your questions in the chat. In this episode of the Mornings with Joel CRE Podcast, Joel sits down with Derrick Barker, co-founder and CEO of Nectar, to explore how alternative capital is reshaping commercial real estate financing. Derrick shares his journey from Wall Street to becoming a multifamily investor and entrepreneur, along with insights into scaling real estate portfolios without relying solely on traditional bank loans. Whether you're an investor, broker, developer, CRE professional, this conversation offers practical strategies for navigating today's lending landscape and unlocking new growth opportunities. Live starting soon. Ask your questions in the chat. In this episode of the Mornings with Joel CRE Podcast, Joel sits down with Derrick Barker, co-founder and CEO.
Hello, and welcome to the Mornings with Joel CRE Podcast. As always, we're very excited to have you with us today, and we are happy to have you sit in on another show. Today, we have Derrick Barker with us this morning, and very, very interesting business model that I've been familiar with for a few years, and I wanted to share with you because I think they're doing some fantastic stuff. So, Derrick, how you doing, man? It's good to see you again.
I'm outstanding. Thanks for the intro, and it's good to see you as well.
Yeah, absolutely, absolutely. So, let's just go into a little bit of background, because your company name has nothing to do. It doesn't sound like it has anything to do with real estate, but I'm sure there's a reason why you use that name and how you tied it in. But just a little background. You're a Harvard grad, landlord, went to Goldman, fixed income. You did all this stuff, so you got this pedigree, and then all of a sudden you decide to jump out the window and become an entrepreneur. So tell me a little bit about this. How'd you wind up to where you are today in your real estate background?
Yeah, so the reality is that I have always been an entrepreneur. An entrepreneur is more who I am. I've had various occupations, but I've just been an entrepreneur, because that's my personality. Even when I don't want it, even when it comes with its downsides. But my freshman year at Harvard, I started a business. It ended up going really well with a couple of my roommates there. We was really got into the finance world through that organization. That was in '06. In '06 and '07, that was great. In '08, we decided we had to probably do something else.
Yeah.
I got into real estate. We start working on, okay, how do we pivot and get into a real estate business? Because we figured, there's a big real estate crash. There's, can't go down any further. So we bought our first property in 2010. We were wrong because it could go down further. But I ended up getting a job at Goldman Sachs. Trading, fixed income was a great way to learn about risk and how illiquid markets work and the like. And real estate is just another illiquid market that has some different characteristics than other securities. Um, but I continued to grow my real estate portfolio. By 2013, I had 500 units,
Mm,
multifamily units down here in Atlanta. So I was buying and renovating single family, then quads, then portfolio quads, then a broken
mhm,
condo deal, then a portfolio of apartments. So we were just kind of growing and growing. And then by that time, I had about 500 units. It was time to leave. So I left Goldman to build out a company that bought distressed apartments. And that's what we bought, renovated, asset managed, did some developing, turning around apartment complexes, mostly in the Southeast, but also in Southern California. So that was my background before Nectar. Did that
mhm,
for several years. And what I realized was that there are lots of great property owners, like property operators, who have great businesses, who own hundreds of millions of dollars in assets, who don't have access to credit at
yeah.
the company level. They can get a mortgage, but for an apartment complex, but they don't have any credit that they can use for their company if a $500,000 issue comes up or if
Hmm.
they need to move quickly to buy a deal. And so in 2019, 2020, by that time, a lot of capital had come into the market. And the opportunity set that I built a business around, which is buying distressed assets at huge discounts, the opportunity set wasn't there,
Yeah.
really. You could buy
Let me ask
distressed
you this
assets.
because you bring up a good point, and I want to spend a lot of time on where you're headed, right? So
Okay.
let me just go back because there's a question that I always get from different audience members, and it's like, how'd you get started? Because you're a young guy, you're working at Goldman, a full-time job, but yet and still you're buying 500 units. So give us a little background on that because that's the question I always get, and then we'll kind of build from there. So just let's cover that little piece if you don't mind.
Yeah, so I mean, we were bought our first deal when I was still a senior in college. It was me and my two roommates, and we just went out and did the old-fashioned, who are all the alums, who are all the people, who can we get connected to, who we can get in front of and pitch
Hmm.
thesis. The thesis was we were talking to mostly people in New York where cap rates were very low,
Yeah.
and we were saying, hey, you can buy these properties in Atlanta and the prices in Atlanta are more similar to prices in Cleveland, but Atlanta has all this economic growth and all these
Mm,
Fortune 500 companies and all of these things. And the difference is, and you can buy at the time you could buy properties at 10% cap rates. Doesn't even have to be levered, unlevered, you can get 10%.
mm.
And so we had some people who gave us a tiny amount of money. I'm talking 50 or $75,000 altogether. Um, and we were able to do our first deal. And we flipped it. And they were like, cool, that was great. And they gave us money for the next deal and introduced us to some friends. And then went and did that. And then we
Okay.
raised $1 million to do it. So it was like we were making no money. All right.
Yeah.
We were taking money from our jobs and using it to help us do this. All right. For years, for years. And we built stone by stone a little bit of a track record, just doing the best that we could and learning and having the market go up and bail us out sometimes. And that's how we did it. We ended up going and we had to get a guarantor because we had to get when you get a mortgage, they look at your 23-year-old balance sheet and
Yeah.
based on experience, and they're like, no, we don't care what kind of syndication you have behind you. So we went to a family office that was a real estate family where the patriarch was very elderly and he helped us. He co-signed and he put up some GP capital so that we were able to go and do our first deal and do our first apartment deals. And then we built up a portfolio in that structure where we had co-GP partners who were signing guarantees and putting up some of the GP capital and taking most of the economics. Like we were working for like we
Yeah.
were
Working for them, basically.
yeah, we were entrepreneurs in name, but in reality, we were doing all the work and we were getting like a small amount of the money. But we built a track record and we built some amount of cash so that we can then go and do smaller deals where we owned much more of the
Mm.
actual economics.
Economics. Yeah.
And like this, and we just kept on doing it. That's kind of how we got there.
All right. No, that's good. That's good because it's almost like everybody's like, well, what's the shortcut? And you just made it clear there is no shortcut,
No,
right? I
no.
mean,
It's a
yeah,
shortcut if you're just saying it. It's like, oh yeah, I got started and then 500 units. Like the
right.
shortcut is hindsight. That's the only shortcut.
Right. Exactly. So very good. So great. I appreciate you giving us that background. So let's jump back into to where you were headed. Um, so you see this opportunity in the marketplace, distressed assets in Atlanta, much higher cap rates than you had in New York City, for an example. And you see that you had a lot of property owners that were basically illiquid, is basically what you were describing, and that made a bell go off, it seems like.
Yes. So yeah, they're exactly right. We were a property owner. At one
Hmm.
point, we had thousands of units. We had over 1,000 units because we were turning them over, so we didn't always have. I mean, I ended up buying and renovating almost 5,000 units. But since I was turning them over, there were sometimes we had like 1,000, 1,500 units. But that's not, you can't go to a bank and say, hey, I need $1 million to buy this deal
Hmm.
in 30 days. It's just not how, they'll give you a mortgage, but or hey, I'm 90% finished with this renovation, but it turns out the ship is delayed. So my shipment from China for the doorknobs and like, can you give me that wasn't, so we started Nectar in order to provide that capital to go to high, credit-worthy sponsors,
Hmm.
experienced sponsors. They have portfolios. Their portfolios are cash flowing and they're generating, returns
Hmm.
and providing credit to these sponsors. We're backed by their assets and the cash flow coming from their portfolio. So, and that's what Nectar is. We call it Nectar because cash flow is the sweetest thing in real estate. Some things
Ah,
you
that's the
don't.
connection.
Yeah. And we would lend against the cash flow, just like, and that's why we're a hummingbird, because a hummingbird, it just doesn't take the whole flower. It just like takes the nectar out of it, the sweetest part. So that's us. We're looking at cash flow. Are you cash flowing? Can you cash flow at this exact rent? Is cash flow going to happen if the market doesn't change and nothing goes up? And we lend against that so that sponsors who are strong sponsors can do the things they need to do to operate their business.
Gotcha. So the money doesn't have to be put in a reserve for, CapEx or anything like that. It could actually be used for OpEx if you needed it for that, or
Yeah.
even to buy another property or anything else.
Anything else. We are providing capital to sponsors backed by their portfolio, their cash flowing portfolio. If that makes sense.
Yeah.
And because of that, we've been able to have a non-correlated asset for our investors where they can invest in our fund and they have something where it's not reliant on the real estate market going up or stock markets going up or rent appreciation. It's just, you are lending money and you're backed by a portfolio of assets, diversified portfolio of assets that are generating cash flow today,
Hmm.
not a bridge loan where one day you're going to fix it and it's going to generate, it's not an equity deal where, one day you're going to hopefully sell and make some money. So it's a good structure from an investor's perspective to be diversified and have real estate exposure and have hard asset exposure where it's not AI isn't going to take this away.
Right.
But you have cash flowing, and it's a good structure for the sponsors. You're a strong sponsor, and you have flexible capital that you can get quickly. And it's you don't have to have a $10 billion portfolio and go to Goldman Sachs. You can have a $50 million or $100 million portfolio
Hmm.
and get 50, $500,000 or $1 million to do the things you need to do.
Yeah. Very interesting. Now you mentioned that this is something that AI is not going to take away, and because of your background in technology and the things that you've done, I'm understanding that you're using an AI component in your business model now. What does that look like? Can you explain that?
Yeah, so I mean, the reality is AI, it can be a force multiplier. So what we've used it to create applications that allow us to clear bottlenecks in our business.
Okay.
We've allowed it, it's allowed every person to be, my view is that the people that are the practitioners, the business people that are on the ground doing work, they know what they need and the tools that they need best,
Hmm.
more better than a developer in Silicon Valley most of the time. And we have trained and empowered our team to be able to build their own tools that they need. And we organize it in such a way where we can say, where we have a process where we are able to use AI to, in every single aspect of the business,
Mhm.
portfolio management, originations, credit, like every single aspect of the business is embedded in such a way where it allows us to unlock additional um, productivity, allow us to sometimes do the same thing better, or the same thing faster, or just do new things.
Mhm.
An example is from a portfolio management perspective. We have 150 deals in our portfolio, over 150. Um, the old school methods of of checking credit, you get Clear or Thomson Reuters,
Mhm.
or you get pay for one of these subscriptions that give you alerts. Well, with AI, you can do your own searches every single day, as opposed to paying a third party to give you effectively public information,
Mhm.
on a 3 week or 1 month delay. So that's just one example, but there are little examples like this across every single part of the business.
Okay, okay. So you've primarily been using it as an internal mechanism to make yourself more efficient, as opposed to anything external. Are you using it in any way to service clients, or is that something coming down the road?
Yeah, I mean, um, we've built a portfolio dashboard so that our investors can have direct asset level insights. They can see what's going on at the asset level in real
Okay.
time, or at least on a monthly basis, because that we built and that we're able to keep updated and fresh using AI. So and again, at every aspect of the business, it is a tool that's a broad tool. It's kind of like saying, well, how do you use electricity in your business? Well, I mean, every way.
Yeah,
You
yeah.
know, uh, if that makes sense.
Yeah, yeah, no, I get it. I get it. All right. You know what? That's actually a good segue point, because what I want to do is start talking about deal structure a little bit.
Okay.
But we're going to take a quick 20-second break for our sponsors, and we will be right back here on the Mornings with Joel CRE podcast. Thank you for staying.
The Impact Air 99. We asked real people try the Impact Air 99.
Breathable, light, but protective.
Feels very comfortable wearing it. It looks cooler.
It's almost surprising how much air you can get in.
Engineered with 6 layers of nanoscreen technology that blocks over 99% of viruses and bacteria while allowing you to breathe freely and speak clearly.
My glasses are not fogging up.
I could wear this all day.
The Impact Air 99. We asked real people try the Impact Air 99.
Breathable, light, but protective.
Feels very comfortable wearing it. It looks cooler.
It's almost surprising how much air you can get in.
Engineered with 6 layers of nanoscreen technology that blocks over 99% of viruses and bacteria while allowing you to breathe freely and speak clearly.
My glasses are not fogging up.
I could wear this all day.
The M.
Okay, all right. Thank you all for staying with us here on the Mornings with Joel CRE podcast. We're here with Derrick Barker at Nectar here in Atlanta. So, Derrick, before we went to break, we were kind of talking about what you've been doing as it relates to AI and how that relates to electricity. You use it in all kind of ways, right? So you're kind of doing the same thing with AI, and I appreciate you sharing that. And the transparency for investors, that's very important as well. So thank you for that. Let me ask you this. In the typical model, you have your senior debt and you have your equity, right? And so Nectar kind of fits in the capital stack between those two, generally in an area where we would call that either mezz or preferred equity. You tell us, what would you define Nectar's contribution to be? Is it more a debt product? Is it more an equity product? Is it a hybrid? What is it?
It's similar to a debt product for the sponsor that they
Okay.
can use as equity if they need to in their deals.
Okay.
But we are advancing the sponsor money, and we are backed by the equity that they have in their assets. And we, as our business model, we look to cash flowing assets.
Hmm.
So it is a debt backed by equity. Technically, the structure it could be structured as a structured equity vehicle. So like there are different legal structures depending
Hmm.
on your capital stack. Um, or it could be technically an advance, like there, or cash flow assignment agreement. So we have different legal structures. They come to the same conclusion, which is that we're giving the sponsor money, uh, and they pay us out of the cash flow coming off of their assets. And if they once they make their final payment, we're out. They keep their upside. We don't get any upside. They keep their upside. If they don't pay, then well, we have the ability to force them or to sell their assets and recoup our what the the
Sure.
financing we provided via the
Hmm.
proceeds.
Okay. Okay. All right. Very interesting. So it operates more, I guess, similar to MES from that standpoint, but with a different structure, and a much more liquid structure, because I know you guys get capital out pretty quickly,
Yeah.
as well. Yeah.
Yep. We can move pretty quickly. We've gotten deals closed in 7 days. We've
Mm,
gotten deals closed with repeat sponsors in even less time than that.
yeah.
Uh, our goal is to be fast and thorough. And the way to do both is to be organized and to
Yeah.
leverage technology. Technology works if you're organized, and we are able to do both.
Okay. All right. Sounds good. Sounds good. I get that, and that makes a lot of sense. Now you guys have, from what I understand, been paying out distributions also over, 14 straight quarters, which has been great. What is exactly happening inside the portfolio that enables you to do that? Because there's highs and lows. There's, a lot of movement in the portfolio, but it seems like you've been able to find a steady line there in order to be successful in doing that.
Yeah,
What's the secret sauce?
that's right. That's right. And I love to talk about the real estate market because the real estate market, since we've started, has gone down. Like the
Hmm.
multifamily market has gone down. And what we're seeing in the market today is there are a lot of people there is, it's an opportunity rich environment, but it's a distressed environment out
Yeah.
there. Um, we underwrite to assets that are cash flowing with low leverage fixed rate debt. So if we're gonna, when we talk to a sponsor, the first thing they say is, "Hey, look, we have this problem." Okay, like that's a lot. People come to us a lot of times. There's some problem that they need solved,
Mhm.
and we'll say, "Cool, send us your schedule of real estate owned." We look at the schedule of real estate owned to see what does your portfolio look like outside of just this one problem. Now, it might be a portfolio where the whole portfolio is a problem, and that's just not us. Like this is not
Mhm.
our that's just not something that we can work with. Or
Sure.
they have a strong portfolio with the problem somewhere, and sometimes the problem is, hey, I just need liquidity to get this next opportunity. So it's not um, we attach to assets that are cash flowing. We can attach to a whole several assets in the portfolio that's cash flowing so that there's enough just cash flow and equity cushion there.
Hmm.
Um, and we get capped upside. So usually they're going to use the money to do something that's going to bring them additional cash flow in the future. But for us, we have, okay, this is what you have is cash flowing now. We're going to give you, we're basically advancing against the future cash flow coming off of this portfolio. And because of that, my what I like my view of risk is, the two biggest things you can do. There are really three things you can do to de-risk real estate. One, you have to have the right partner. Like you can have a perfect property. If you have the wrong partner, then it doesn't work. So we make sure that we work with good sponsors, good partners. Second is leverage. You know,
Hmm.
if you have moderate leverage, and third is cash flow. The second, if you're cash flowing, if you have the appropriate amount of leverage where you can generate net cash flow over and above the mortgage, it dramatically de-risks real estate. And
Hmm.
that's what we focus on from the beginning. So we have assets that we did, we have deals that we did in 2021 and 2022. People remember that time where, the portfolio has gone down and the property values have gone down, but when it comes down to it, they were cash flowing then. And now, even if they've had, if they've had, rents have not been able to keep up, they're still cash flowing now, and they've been able to perform. And that really is the thing. We aren't underwriting based off of projections. We are not underwriting based off of rents going up 5% a year or 2% a year. we're underwriting based off of what is going on right now. Do you cash
Yeah.
flow right now with the current conditions? If not, then it's just not, um, it doesn't work.
Yeah, yeah. No, I got you. I got you. So what type of levels of leverage do you look at? What terms are you looking at? I mean, what does that box actually look like from that standpoint?
Yeah. The my favorite, like, of course, an investor's favorite thing to say, and the listener's worst thing to hear is that it depends, but it does. It's the reality. But we're looking at with today in today's environment, we're not going to go above 80% leverage.
Hmm.
So we're looking at a portfolio again, and we're saying, okay, well, we want to see like where there you have to have fixed rate debt, you have to have leverage that's less than 80%, ideally even less than that. And like, so across our portfolio, our average LTV is less than 70% because a lot of these deals we've done, we'll finance the deal that's cash flowing and that they did in 2014 and it's
Hmm.
paid down and all that stuff. Um and, and our cost of capital is going to be in the teens. So I'd say it's really, you know, we're providing, fast capital, flexible capital that's hard to finance things. We're not going to be as cheap as a mortgage. So I think of it, compare us to, you're going to use us in a place where you otherwise would have to use GP equity, which is the most expensive equity, or LP equity. We're going to be cheaper than LP equity or cash out refinance proceeds. So for instance, if you have a $20 million property that has a $10 million mortgage and you need $1 million to buy your next deal, where we'll come in is, hey, instead of getting an $11 million mortgage, we're gonna have to pay a prepayment penalty, an origination fee, legal, and your interest rate's probably going to go up. Like
Hmm.
in order to get that $1 million, that's an incredibly expensive $1 million, even though the baseline rate might be lower than our rate. We will just give you the $1 million and keep your debt in place. So that way you get the cash out that you need to do whatever it is that you need to do into the future.
Hmm.
But instead of doing all of that work and paying all of those fees and transaction costs on $11 million, you have it just on that $1 million, which is dramatically cheaper.
Yeah, yeah. No, that's a good point. Um, so that makes sense. I definitely understand that. There was something I was looking at also where there was some cloudiness as it relates to, and I forget what you call these type of loans, but MCA loans that are out there in the marketplace. What's the clear distinction between this and a MCA type loan?
Well, MCAs are just, much more expensive. MCA, you're taking it. So for people who don't know, a merchant cash advance, you are going to, get advanced some amount of capital, let's say $100, and you're going to pay a multiple, say, you know, 1.3. Uh, but you're going to pay it out of cash flow. Sometimes they pull the money daily or weekly, and they're going to take it and it's going to amortize down over 6 months or something like that, or 3 months. So it's going to be a 1.3x in 3 months or 6 months. So we're talking 60% IRR type returns.
Hmm.
We do fill a similar space in that, we are we're giving the companies flexible capital, looking at their cash flow, backed by their cash flow. Except for because we are advancing to property owners where they have real collateral that's not going anywhere, we're able to have a dramatically cheaper cost of capital. You can think of this as just a more like a reasonably priced, longer term MCA, but only for property owning companies.
Okay, okay.
Uh,
All
so
right. So yeah, go ahead.
So yeah, so like if you're a restaurant, you don't have the option for Nectar, so you have the option for MCA. If you're
Right,
a trucking company, similar. But if you own apartments, if that's your business, then you have Nectar instead.
right. And you'll do any asset class though, right? I don't think you're just multifamily.
We'll do any asset. We'll look at any asset class, but we are my background is mostly multifamily. I've also done self storage and some hotels and some other stuff. 75% of our portfolio is multifamily today. But we have a self-storage portfolio in the Midwest. We have some yes, have some hospitality, some single-family residential, some short-term rentals. So we have some other asset classes, and we look at anything that's low leverage, that's cash flowing with rich sponsorship.
Okay. Period. Bottom line. That's what it boils down to.
Yeah, that's what it boils down to.
Yeah, yeah. And what term are you generally looking at?
Well, about 5 years. I say,
Oh,
typically 1 to 5 years. An average is probably three,
okay.
just because, but we are not going to go past your mortgage maturities. If that makes
Hmm.
sense. Like we're not trying to take refinance risk. Like that's not, we don't want to. So if you have, 20 properties, we're going to look and see, okay, well, where the mortgage is ending. That's how we're
Yeah,
going to
yeah, yeah.
structure. That's how we're going to be structured.
Right.
So if they're all ending in 2 years, then it's going to be a 2 year term.
Yeah, yeah, which makes sense. You're not going to extend out beyond the term of a senior note. So
Right.
I've never seen that in the industry. So so I definitely get that. All right, that sounds good. That sounds good. Let me pivot a little bit and talk about the industry and the market and some of the things going on there.
Yeah.
There was a prediction of a wave of refinances that were going to need to take place because of distressed assets back in the 21, 22 timeframe. Um, what has happened with all of that? Has that transpired? Has it not transpired from your perspective? And where does that kind of leave you as regards your business model?
To be interested, I'm very interested in your perspective as well. I
Okay.
would love to hear your thoughts. We're
Okay.
seeing it happening and we're seeing it not happening. Um, if that made like, yeah, people did deals with 5 year terms in
Mhm.
2021 and they're due. It's happening. And we're seeing a lot of people who they're at 90% LTV.
Mhm.
They're at 110% LTV. They're at, and there's like we're seeing a lot of that. I don't know. And there's some times where lenders are letting people work things out, which makes sense. And there's sometimes where it's like there's nothing to be worked out. You have to bring new cash to the project because people have they got their financing together, put their capital stack together at a time where they thought rents were going to go up, but rents went
Mhm.
down. They thought that expenses were going to be similar. Expenses went up. So some of these properties, their business plans they're never gonna get there. It's just, they're never gonna get there.
Yeah.
And they have a loan whose payments are based off of projections that didn't happen. And so they're paying, we see three type of people. Some people who are, they're in this situation where they're barely breaking even, they're barely
Mhm.
making debt service, but they aren't making enough money to reinvest it in the property to keep the units fresh
Yeah.
and it's a more competitive market and they're
Mhm.
struggling and there's zombie
Right.
properties, lots of zombie properties out there that are honestly, they're going to struggle. They're going to continue to struggle. Like, so we see a
Mhm.
lot like that, but they're going to struggle, but the sponsor's holding on. So there's nothing to, so they're not transacting. We've seen some that are like, they're zombies that are just like, it's over. They're dead. Like, you can't make them,
Yeah.
you got to the extension or you got to the maturity, the lender's like, hey, we're not extending. Like, you got to bring in the money to turn the units or pay us down or both. And they
Yeah.
can't do it. So they're getting forced sales. So the most reliable transactions that are happening are forced sale transactions because buyers and sellers aren't seeing eye to eye. People who aren't forced sellers, a lot of times they get down to the offers and they're like, I don't have to take this, and they're not.
Mhm.
But the forced sales are the ones that are happening. So there's a lot of opportunity in the market. You have a second class of people who have um, they have properties that are cash flowing, but really they're still not hitting budget. They're not getting upside or all those things. And then you have people who they figured it out. They've worked through whatever things they need to work through, and they're in the market looking for opportunities. And this is an opportunity-rich environment, but you have to pick through and a lot of people who are still hoping and wishing. So
Yeah.
is that I know you have people that you talk to on the
Yeah.
podcast. How does
Yeah.
that
Well, yeah,
sound?
I mean, I kind of view the market right now as the twilight zone, where generally you have predictions of what's happening, oversupply, and then, restoration and you kind of look at that whole model. But it's been really interesting because you have wrenches that were thrown into the system, like you talked about interest rates, everybody's thinking one thing and it turns out to be another. The tariffs was an issue that nobody really thought about, which threw prices, through the roof. That kind of turned things a different way. Um, so it's kind of there's been so much, in my opinion, trepidation in the marketplace as regards what's going to happen next, that there's a lot of capital sitting on the side. And with that capital sitting on the side, people that need that capital deployed to help save their deals or restructure them or to get them done, they're not able to make that happen. So, to your point, I think it's an opportunistic market. In a way, it still has that Twilight Zone kind of feel to it, in my opinion. But I don't know. We'll just have to kind of see where it is. I've seen a pivot from development to acquisition. We're even looking at it from a more acquisition basis than development. But on the flip side of that, you have properties that are fully entitled with a great land basis that now, because of that softness in the market, they're never going to be developed. So that creates an opportunity as well. If you have problems like you just talked about in the marketplace where these older properties are not able to get the capital that they need to keep up with the market. So you come in and you develop a new product, you just totally dominate the market and can drive rents. So it's a very interesting time, so to put it bluntly. So
Yes, very interesting time. Very very exciting. And it's yeah, because of where we sit, we get to see both ends of it. We get to see people who are honestly, we get to see in single individuals, people who have some properties that are fine, have some properties that are distressed, and are trying to buy distressed opportunities. So we get a bird's eye view here at
Yeah.
Nectar. And yes, it is an opportunity-rich environment, and I see that continuing. I see that continuing.
Yeah, absolutely. Absolutely. I do want to ask you about something else. We're going to take a quick 20-second break, our second one of the show, and then we will come right back here on the Mornings with Joel CRE Podcast. Hang around. You'll want to hear what else we got to talk about with Derrick Barker of Nectar. We'll be right back.
Step into the future with EcoCrypt, a platform unifying decentralized finance with real-world utility, where value flows freely. From gaming achievements to real-world assets, everything can be tokenized, fractional, and accessible in one trusted ecosystem. For gamers, investors, and global communities, EcoCrypt is breaking down barriers and democratizing finance. Join the revolution. Visit ecocryptusa.com today. Step into the future with EcoCrypt, a platform.
Thank you. We're back here on the Mornings with Joel CRE Podcast with Derrick Barker at Nectar, and very exciting conversation. Derrick, appreciate you still being here with us and covering these key points. As you know, before we went to break, we were talking about where are we at in the market? Is it a buyer's market? Is it a developer's market? Is it up, down? Is it sideways? What are the opportunities in the marketplace? And there was a thought that I think you were about to carry forward. Well, did I cut you off at that point? Go ahead and make your thought.
Over the break, I
Yeah.
forgot my point.
I got your point.
But
Okay, all right, it's all good. It's all good.
I do have thoughts on whether the market is up or down and sideways.
Yeah, please go ahead. Yeah.
Yeah, I mean, the market is certainly down. Like the market is down. Their interest rates are higher than they were.
Mm-hmm.
Rents are lower than they were. The expenses are higher. Like there's just from a math perspective, the market is down. We are still in a market where there's a structural supply demand imbalance. So what we're seeing is there's a lot of absorption. The units are being absorbed, but the reality is, if you take the entire real estate market as like one street, if you have a property on the street and then you have vacant buildings that just got built on either side of you, there's a lot of competition for the people walking down the street trying to find a place to live.
Yeah.
That's going to make it hard if you're sitting here and your building is full, but these two people are leasing up. It's hard for you to raise rents because you raise rents a little bit, then that guy with the half empty building, whose lender is looking at him like, "Hey, I'm taking that asset if you don't hit this, this, and this."
Mm-hmm.
They're gonna figure out how to get that renter, whether because their butt is on the line, or they're going to transact at a basis that's lower because they're going to lose the property. The lender's going to say, no, like you're not going to get there. Then the lender's going to sell the property for less than it was built for. And then that new buyer is going to have a property at a lower basis with less debt that they can charge less in rent. So that's going on in the market. It's going on all over the place. Things aren't being built. So we know, like built. So we know, like the people who make it through, the people who get through this period, there's going to be a period in the future where demand again is about the same, maybe a little bit higher, a little bit lower, but supply is dramatically lower. And that's going to be the environment that you want to own assets in. It's just that a lot of people, like we're not going to be able to get there until a lot of people with broken capital stacks are able to get out of those broken capital stacks. And it's called a deleveraging. There are a couple ways to delever. All of them involve new capital. One is you sell the asset for a loss. Then the new buyer brings in new debt that's lower. There's less debt. They have a lower interest rate. They have lower interest payments because it's less debt. They can charge less rents.
Right.
But that's going to happen. Or the owner brings cash in and lowers their debt. Um, or there's an ability to just hold on and just service it and just make it happen for long enough that asset values recover. And then you're able to delever because asset values eventually recover and you hold on. Like those are the only three ways that a deleveraging happens. But a deleveraging has to happen. All three of those things are going to happen. And there's going to be a lot of, there are a lot of people that are holding on that are slipping, that are not going to be able to hold on. And so they're going to be new transactions. I like that. We are not going to see a recovery until we see that. Like there is no other way around it because that's going to force rents down. It's going to force, it's going to, and then once those rents go down, and the market is right sized, then, we'll see, we'll see things go back up again. Is that a 1 year thing? Is that a 2 year thing? Is that a 5 year thing? Well, the '08 market didn't turn around until 2012.
Yeah.
Bottom was 2012, and then it kind of trickled for years after that. So
yep.
that's
Time will tell.
it.
Time will tell. Time will tell. Without getting specific on markets, what part of the country do you think is ripe for opportunities like how you built your career?
Yeah.
For I don't want to say bottom feeder because that's not a good term to use, but you know what I'm saying. Just
I do.
distressed opportunities in the market.
Yes, I'd say acquiring at a reset basis.
Right, there you go.
It's better.
That's boardroom speak.
Yes, yes. Sam Zell called it grave dancing. We don't want to call it that either. Though he was a great in the real estate market. So, what parts of the country are there opportunities? I will say the reality is there are opportunities in all parts of the country. Nectar is in 45 markets across 29 states. So we get to see, and different markets are very different. Sometimes in the market, there's a lot of correlation. Right now, there's a lot of dispersion, which means that there's a lot of just difference in the details of what opportunity looks like. However, there's my opportunity all over. We looked at a deal in San Antonio. San Antonio is a very, very high supply market. It's also a high vacancy market, where you had the deal that traded at $135,000 a door in 2021, got 50% through the renovation. They realized they couldn't get the rents that they were projecting. And so they gave it back to the lender. And the lender just sold it for $25,000 a door. $25,000, a deal that's halfway through a renovation.
Wow.
So like whoever's buying it, they're buying a half rent, and they can get it up and gut it and have it be the nicest thing in the neighborhood at a $65,000, $70,000 a unit type basis.
Yeah.
Where other properties in the area are trading at 90, 100,000 a door. Still much less than 130.
Yeah.
Higher than 70 or 75. Those are opportunities that are happening, but you're in a market where you're there's a lot of supply out there, and there's a lot of vacancy in the market, and but that's the kind of opportunity you get there, and you probably are going to make a lot of money. because the reality is
Yeah.
you're taking that risk, you're going in, but you're providing the nicest thing at a lower rent than everybody else who's not as renovated.
But that's the only thing that saves that deal is because your basis is so low. The current owner can't get down there. So he's got to exit and have somebody else come in. So yeah,
That, yes,
yeah.
that's not
That's
happening.
what saves it.
That's what saves it.
Yeah.
That is, I say, that's what you have to see in these high supply markets. You just have to basis reset. There's some markets that, we're looking at, a couple markets in the Midwest where, is not that dramatic. But, there's, you can still buy properties that are stabilized in cash flowing, but the mortgage is just too high.
Mm.
Or the sponsor got in trouble because some other part of their portfolio and they just have to sell. And you still have cap rates that are higher.
Mhm.
You can buy deals that are, we're looking at a deal in the Midwest that a sponsor had, they refinanced it at a $120 million or $120,000 a unit type valuation. It was a refinance,
Mhm.
1,000 unit valuation. And now they're looking to sell it for basically just, you know, 85, 87,
Mm.
90,000 a unit. So it's a 30,000 unit discount. They're selling it. They're gonna make more than the debt, but they're a forced seller. They'll be able to recover the debt. It's still a good discount, but it's different. It's not the same. It's not a 70% discount. Uh,
Right.
but we're seeing opportunities like this where you just have people that are distressed, asymmetric type deals. We're seeing them all over the country.
Yeah. 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 Well, I mean, those are good examples, and like you said, it's kind of those, maybe not if you look at the broad market, but those opportunities in those selective markets where you can find those deals. So that's a very good example of what can happen. So
I will say
yeah.
that there are strong sponsors all over the country too. I know, like this has been a doom and gloom podcast a little bit, and there is
So
some
let's
doom.
turn it around.
There is some doom and gloom out there. That's just the reality. However, like there are plenty sponsors out there who did not participate in the craziness, who
Mhm.
said, "Hey, the numbers are just not penciling, and I'm going to bid this," and they didn't buy a lot of deals in 2021, 2022. Or they did, but it was low leverage enough. And they're not hitting their projections, but they still have strong portfolios. And there's still that out in the market. And I know because we're partnered with dozens of sponsors like this all throughout the country. For these sponsors, for the people who have been disciplined, who have low leverage cash flowing assets, who have local knowledge and local teams and expertise, in markets like this, these people are returning to the market and getting the deals. These are the people who are getting deals. It's not as much the outsider coming into the market and syndicating. We're not seeing it's the guy who he didn't really buy a whole lot. He owns several properties, has low leverage fixed rate debt. They're owner operators, and they're getting opportunities because because they can go in and execute and come in and they know where the prices are. They know where they would take rents, and we're seeing them have their day across the country.
Yeah, yeah. And they know the market because they're in that market and have deals in it. So yeah, yeah. I mean, so no, that makes sense all day long. I certainly understand that. Um, Very good point. Let me ask you this as we kind of get down to the end of our time here. Um, you built this whole model off of identifying a hole in the marketplace, a distressed situation. People need liquidity, they can't get the liquidity, and they have all these assets, and we see that. You know what? It's almost similar to, well, not exactly, but I was thinking about the reverse mortgage model, where you have a lot of senior citizens that have a ton of equity in their home, but they don't have the cash flow in order to get a mortgage, so there has to be a workout. So in this particular case, these properties have cash flow because that's what your model's based off of. That's what protects your investors. But at the same time, they can't get access to their cash without having to refinance the whole property, and nobody wants to do that, right? Because they might have low fixed interest senior debt, which makes sense all day long. So in a situation like that, I was thinking about another area in the market where there's a little bit of a hole, if you will. Have you guys ever looked at like pre-development capital? We get calls for that all the time, but that's risky money. But what are your thoughts on that? So they could
Um,
be buying something that is cash flowing right now.
yeah, we love doing pre-development capital.
Really?
However,
Okay.
we're
Okay.
going to look
However,
we're going to look at your existing schedule of real estate owned and look at the existing equity in cash flowing assets, and we will provide you the pre-development capital you need backed by those assets.
okay. All right. Right.
So,
Which basically is, yeah, you're allowing them to do whatever they want with the money. If they want to use it for pre-dev, they
yeah,
can do
we're
that.
doing
So,
a deal right now in Texas, a great sponsor. He has 60 properties. He's looking at outstanding opportunities. I was able to drive around Dallas with him, and like, he's a local owner operator. He owns a management company. He has, so vertically integrated. Beautiful assets he's able to get, deals that, like, you only get because he's like, yeah, I've known the owner for 10 years. I kept
hmm.
asking and asking, and now he finally, like, these type of deals are out there, and he's getting just home run deals.
Yeah.
And
I'm
he
sorry, man.
wants pre-dev, and
Hmm.
I just but he has this portfolio of assets, and we're able to provide him the capital so he can go
Yeah.
and hit home runs and keep the upside that he worked for and deserves.
Yeah. Yeah. So very good point. Very good point. And I like your answer on that because it's still the model. The model doesn't change, but the applications of how it could be used certainly did exist. So that makes good sense. Um, so with that all being said, what would you want to conclude with as it relates to our audience? What do you want them to know? And because basically, if a nectar didn't exist, I think we would see a lot more blood in the water. So, you know.
There's blood in the water, all right? It's there. Or there's, like, again, there's like zombie properties. The blood isn't there yet, but there's this the is it the vultures are circling.
Right.
That's the market that we're in. And, like, that's not the whole story.
Hmm.
That is part of the story, but it's not the whole story. There are plenty of people who have strong assets, who are strong operators. Now it's their time, and we are partnering with them across the country. And we've built a model where we've been able to identify these sponsors who are the people who they have been prudent. They've built a company that's sustainable. They've built a portfolio that's sustainable. They have fixed rate debt. Um, we are partnering with them to take advantage of this market. There are only a certain number of windows where you can do deals. One of my investors said, "Hey, uh, you know, if I could go back, every deal that I saw in 2014, I should have bought. Every
Hmm.
single one. I should have done, I should have done, bought everything on the block. And all would have gone up, and I would have made money. And I shouldn't have bought anything in 2021. There was nothing that was like, it's like there are some times, and most times, you have to everything else. Now is one of those times where it's opportunity rich, and we might not see another dip where multifamily assets are down 25% across multiple markets for another generation.
Hmm.
It's only happened a couple times in US history, a few times in US history, and it's happened right now. So now is the time, if you're a strong sponsor, to make your swings that are going to be the thing that you retire on. Now is the time, if you're an investor, to get behind the right sponsors. And what I would say for the people who are the holders ons, who have the zombie assets, the reality is sometimes when the value is gone, the money is already lost, and you make money by exiting and getting into another opportunity. And I know it's hard to do, and it's hard to say.
Yeah.
You have to be real with your investors. Hey, I know you thought that it was X, is X times zero, or it's X times point whatever, and we're going to do this because this is just what happened in the market, and we're going to be on our front foot to take advantage of opportunities, because now you can make it back. We're in a market
Yeah.
where you can put the real good money after good properties and make it back.
Yeah. Yeah. As opposed to holding on and bleeding out. So yeah, I got that. So, well, man, Derek, it's been a great conversation. We haven't seen each other in a while, but it's always good to catch up with you.
Likewise.
And congrats on all your success and what you've been able to do. And I'm sure our firms will work together again in the future. And it's a great model. It's a great model. I thank you for having the guts to get out there and say, "Hey, why hasn't anybody realized this?" Get out there and execute on it. So really, really good stuff.
Awesome. Thank you. Thank you for having me, and looking forward to getting some business done.
Yeah, absolutely, absolutely. So thank you again. So for all of you here, this has been the Mornings with Joel CRE Podcast. Again, we thank Derrick Barker for being here from Nectar, and we certainly hope you have a great rest of your week. Thank you so much for being here with us again, and we'll see you next week on the Mornings with Joel CRE Podcast. Thank you.
Are you ready to level up in commercial real estate? Join us on Mornings with Joel CRE Podcast, where we bring you exclusive interviews with top deal makers, investors, and industry leaders. Sponsors reach a high-value audience of real estate professionals. Guests share your expertise and grow your influence. Don't miss out. Book your spot today. You ready to level up in commercial real estate? Join us on Mornings with Joel CRE Podcast, where we bring you exclusive